Good morning. Thank you all for joining us. Welcome. Our panel session on central bank digital currencies and how will the future unfold. As a way of introduction, my name is Julie Monaco. I work in banking, capital markets, and advisory at Citi, and I'm the global industry head for our public sector business. And I have to say that in that business, in two specific constituents, certainly central banks and ministries of finance, a topic that it always comes up in conversation when I travel to visit these clients is digital currency and what should be the role of central banks as it relates to digital currency. And despite the distractions and obviously the challenges and real activities that have had to happen over the last couple of months because of the COVID-19 pandemic, there's actually been, in my opinion, some accelerated interest in central bank digital currency based on two particular areas that were highlighted since the COVID crisis. One is that we've seen unprecedented actions by central governments around the world in terms of fiscal stimulus programs and trying to put money directly into the hands of individuals. And I think if you look at that government by government, you saw that certain governments struggled to get funding to citizens very quickly, especially if they did not have an infrastructure to reach unbanked citizens, which are often the most vulnerable citizens that they're trying to reach. The second is that we've often talked about digital currency and dematerializing money as a way to stop money laundering. And there were reports that when businesses closed down, when we were at the end of March and the early April, in a complete shutdown almost globally in terms of businesses, that there was a huge disruption to money laundering and that it was impossible for money laundering to happen, which I think raised the idea of if legitimate business continued during the COVID crisis, do we really need physical currency? So, in this webinar, you will hear from industry experts on hotly contested topics around digital payments landscape, why central bank digital currency matters, and the roles and responsibilities of the central banks, the Fintechs, the traditional banks, the big tech plays, in building a future where payments are always on and instantly available, and what the role digital currency has in that. We have a wide range of panelists today. The views expressed today are solely the opinions of the panelists. They don't express a specific view of Citi. We're recording this so that people can watch it afterwards. So I want to first thank our esteemed panelists for joining us. I'm going to, kick it off by, I'm going to go to Tommaso first, Tommaso Mancini, Portfolio. I'm going to ask you, Tommaso, to introduce yourself, and then I'll kick it off with you with our first question. So if you could just briefly introduce yourself to the audience.
Yes, hi Julie, it's a pleasure to be here, part of this panel. I'm joining you from Florence, Italy, and where it's beautiful weather. Somehow we feel distant from digital currencies in this Renaissance city. Nevertheless, I lead the Payments, Currencies and Infrastructure division at the IMF and coordinate a lot of the work on these topics.
Great. So the question, as we think about central bank digital currency, the question is not if we will have a digital currency, but when. Can you share with us where you have seen central banks pilot digital currencies, and what are some of the learnings, and do you believe that statement that it's just a matter of when, not if?
Yeah, what's very interesting is that if you had asked that question about a year ago, I would have told you it's all about if. The winds have turned, and there's a majority of central banks that are not necessarily saying that they will do this, but there's a majority of central banks that are dabbling, that are learning about central bank digital currencies, that are investigating the topic and considering the possibility of introducing this digital currency. Again, that doesn't mean that they will. The impetus for this change was in great part the announcement of Libra. And the introduction of other digital currencies by large central banks, prospects of the introduction of digital currencies by large central banks. Of course, there are central banks that have started pilots around the world. Uruguay is one example, several central banks in the Caribbean region. But it's complicated to run CBDC. There are lots of design questions that need to be solved. Should CBDC carry interest rates? Should it be anonymous or not? Or to what extent should it be anonymous? What technology should it use? And for the most part, pilots have not used distributed ledger technology, although central banks are interested in this technology, whether wallets should carry limits, etc. And there's certainly no consensus on this. Central banks are just starting to explore. What's very interesting as we travel around the world and visit central banks in all continents is the diversity of views as to why central banks might be interested. And central banks cite things like economizing on cash management costs as an important reason, especially in very large countries or countries comprising numerous islands. Financial inclusion is another topic, and I know that you're going to delve down into this question, but offering a means of payment to those that are unbanked. The stability of the payment system is very important. Many central banks are concerned by the increasing centralization, concentration of payments in the hands of few large private sector firms. And related to that is the argument of market contestability, the idea of offering an alternative public means of payment that doesn't necessarily need to be adopted in large volumes, but stands as a potential threat to the private sector, and therefore helps with market contestability. And of course, an increasing number of central banks are just interested in this to counter new privately issued digital currencies that they view as potentially more risky. And so they think of themselves as having a role in providing a digital form of payment directly to the public. But of course, central banks are also worried about negatives, about risks. So banking sector disintermediation, the fact that holders of deposits in the banking system might withdraw deposits to hold central bank digital currency, and that would unfund the banks. That's a big concern. That's a concern in normal times. The equivalent concern in crisis times is run risk. The risk that, of course, if there's concern about the stability of the banking system, you see large shifts away from bank deposits to central bank digital currencies. Interestingly, this is actually a concern that is starting to be downplayed by a lot of central banks because of deposit insurance, the availability of deposit insurance in many countries, and the fact that we've seen in a lot of countries that there hasn't been large runs on banks, despite there already existing very safe and liquid assets to hold outside of the banking sector. And then I'll just mention the fact that the international implications of central bank digital currencies is also a risk. The fact that these currencies may be held outside of a country's borders by people who are not citizens or residents. And of course, this might lead to currency substitution or dollarization, we sometimes say. So the fact that in some countries with potentially weaker institutions, higher inflation, volatile exchange rates, there might be a massive shift towards digital currencies of another country. And that currency substitution might destabilize monetary policy control. So those are some of the advantages and disadvantages, the benefits and risks that central banks around the world raise relative to central bank digital currency. And Julie, if I have 2 more minutes, I would just end with one small thought. Is that all right? Yes. So central banks are also concerned with the costs and risks of implementing central bank digital currency. Clearly, this is a new endeavor, needs new capacities, and of course is exposed to risk. So an increasing number of central banks are considering a public-private partnership to offer these digital currencies. And that's very interesting to me. So the idea is that the private sector has a comparative advantage in innovating and interfacing with the customer. So they would be responsible with those functions, including the issuance of coins and the settlement of transactions. And the central bank would be, what is its comparative advantage? Well, its comparative advantage is regulating and ensuring trust in the system. So they would do that. They would issue a license to private sector players to issue tokens. Those tokens would be fully backed with central bank reserves. The firms issuing tokens would be supervised by the central bank. And in a way that would be a way to offer a very safe, very liquid payment instrument, digital payment instrument to the public that is fully backed with central bank reserves, but at the same time not exposing the central bank to the same costs and risks of doing this entirely from A to Z. So this is a public-private partnership, sometimes referred to as synthetic CBDC, which is a term we introduced, or hybrid CBDC. And there are different ways to do this. The central bank might issue and settle and have the private sector distribute, or it might have the private sector also issue and settle. So as you can see, a very wide range of possibilities to implement this, going from full-fledged, if you want, CBDC, where the central bank does everything from A to Z, to a public-private partnership to try to overcome some of these costs and risks. There you go.
Okay. Well, it's interesting because the synthetic method that you're talking about in terms of a public-private partnership is really a digital version of what is done today, right? People don't go to get physical currency from a central bank today. They go to their commercial banks. So in a certain way, really replicating what the role of commercial banks are today in terms of interacting with individual citizens, the safekeeping of that currency. So that's interesting. Okay, we're going to go to our next panelist. So Harish, I'm going to ask you to introduce yourself first to the audience, and then I'll ask you the question.
Thank you, Julie. My name is Harish Natarajan. I lead the work on payments and market infrastructure at the World Bank, and also coordinate some of the activities on fintech.
Okay, great. So Harish, one of the many reasons cited by advocates for central bank digital currency is financial inclusion. What is your perspective on this? How does this fit into, how does the central bank digital currency fit into the broader reform agenda of the area of payments, market infrastructure of central banks, and also governments of emerging markets and developing economies that are very concerned about financial inclusion? How does this all fit together in your mind?
Thank you, Julie. I'll speak from my experience in working with public authorities on payments and financial inclusion in emerging markets and developing economies. Let me start by giving a little bit of context on the state of financial inclusion, what has worked so far, and then I will get to the specific topic of CBDCs. Very clearly, financial exclusion is a very clear development and policy challenge for central banks and public authorities in emerging markets. Just to quote a piece of statistic, the percentage of adults with access to an account in lower and middle income countries is at 63% versus 93.7% in advanced economies. No? And the gap is even wider if you start looking at the usage of accounts for making payments, savings, credit, insurance, and investments. All of them, the gap is almost like half of the advanced economies in the emerging market. So it's a very clear development and policy challenge. Before we propose solutions, one also has to, of course, look at what are the reasons behind it, what's the diagnosis of the problem. And I think based on some surveys we have done, primarily the Fintechs survey, broadly speaking, it is essentially three broad reasons. One is the cost to serve from the private sector. In terms of the cost to serve the unbanked is very high. And then from the user's perspective, it is the cost to access the financial services in the regulated financial services is high. And then there's a question of utility, whether the people feel there's a utility in having an account in a formal financial sector and avail of formal financial services. So I think broadly, these are the three reasons, if you really look at why there has historically been some challenges with respect to exclusion. And globally, there have been three-pronged approach to address this. And all of them have to, of course, work together for it to be effective. The first one is about agent-based models for expanding distribution. And this really addresses this point of cost to serve, and then also the cost to access for individuals. The second one is on tiered KYC and simplification of the customer due diligence requirements. And this, of course, becomes easier with the digital ID. And then the third one is about basic bank accounts and direct provision of payment services by non-bank entities using the e-money construct. And this, of course, has led to unleashing new business models, new players into the market, and then also really expanded the market in some sense. All these three, when implemented together, have had significant positive impact. And in some sense, it has also been a very rapid progress. So if you look at the figures I was quoting for 2011, it was 50% of the adults had access to bank accounts globally. And in 2017, it is 69%. And if you look at specific countries which implemented the strategy, the increase has been over 50 percentage points. So it's not a question of these traditional approaches take more time. They have been rapid progress even using these traditional approaches. So and then of course there's a fourth aspect, which is about interoperable payment systems and fast payments and all of that stuff, which becomes critical once the market expands. There are more players in the market. to promote competition and more efficiency gains, one needs to also then focus on the financial infrastructure to underpin all these different financial services being accessed. Now, here, when we into this context, or when you look at CBDC as a strategy to expand financial inclusion, one has to see whether it is really superior to these approaches. No? And what of these three problems I was mentioning, cost to serve, cost to access, and utility, which one of them does CBDC really address in a far superior way? And the answer actually is no. Specifically with respect to financial inclusion, and my conclusion is that it doesn't necessarily offer a superior solution, looking at the three particular issues I was mentioning. Now, when you look at the different models of CBDC issuance, which has been talked about, Tommaso kind of broadly talked about the centralized, and then there are three different types of decentralized solutions being talked about. So if you look at centralized arrangement of CBDC, you are asking the central banks to basically open accounts for everybody, manage the entire ecosystem. And my question is whether the central banks in the emerging markets and developing economies, do they have the operational bandwidth? Do they have the technological bandwidth now to really go about doing this? No, and this might be a clear no in many of the larger emerging markets and developing economies. But maybe for smaller economies, it might be the answer might be a yes. But certainly for medium-sized and large economies, I think it's going to be very difficult for central banks and emerging markets to really take on this additional burden when they're dealing with a lot of other issues. If we talk about decentralized, both from a perspective of the synthetic CBDC, which is very close to e-money construct, as you were saying, and then also the other variations of using the banking and other intermediaries to distribute CBDC, then you're relying on private sector entities, which you are ruling out to begin with. If you say CBDC is a solution to address financial inclusion, you're ruling out the role of private sector in solving financial inclusion. And now you are then relying on private sector to distribute CBDC, build the ecosystem. Then why would they not have been able to do that with other approaches? So I think there's a dichotomy of saying at one side you say you cannot rely on the existing approaches which were based on the private sector. And then you're saying you want to move to CBDC, but then again you will rely on the private sector. So I think there's a dichotomy there. Then that leaves a question on the table of whether there's a leapfrog opportunity, right? So if countries have not tried any of the approaches, and now they're coming in, suddenly there's a new approach available. Is the CBDC a superior approach? No, is there a leapfrog opportunity there? And I think there one has to really look at the risks. And Tommaso talked about that earlier in terms of the risks to the bank intermediation model, the cost of runs, and so on. And here, a lot of commentators have opined that these risks can be addressed. No? But if you look at the composition of the tools to address those risks, those are based on central banks kind of bringing in extraordinary monetary policy tools. And then also the banks then using other sources of funding like capital markets and interbank lending and so on, which are not developed in the emerging markets to begin with. So you have a situation where neither is it necessarily a proven approach, and then you also have the risks, which mitigating those risks in the emerging market might be more difficult, especially if you're talking about CBDC being the only approach to financial inclusion. So where you're basically assuming then that a significant amount of retail participation in using CBDCs, right? So which the risks are higher and the tools to mitigate them are weaker in emerging markets. So I think this leads me to conclude that in the emerging market context in particular, if financial inclusion is the objective, then there are other proven approaches which should be first tried and which will also lay the foundation for eventual distribution and growth of CBDCs. So I think in that sense, CBDCs is not necessarily the right tool for financial inclusion. But of course, there are other features of CBDCs which might be very, very useful and as part of overall growth of the financial sector. But to begin with, I think to address financial inclusion, first look at the other approaches.
Right. And what would you say, in terms of financial inclusion, which countries would you say have made the most progress in financial inclusion? Well, certain countries that had a significant increase in...
No, I think... Right. I think there are a couple of examples. I think you have in Africa, you have Kenya, Tanzania, which has got significant improvements. In Kenya, for example, the percentage of adults with an account is close to 80% now, almost touching high-income countries levels. And then you have examples of India, which has also made dramatic progress, and also countries like Bangladesh and Pakistan have also made progress. No? So I think there's a wide diversity of countries, both middle-income countries and lower-income countries have made good progress.
Huh, interesting. Okay, great. Thank you. Thank you for your comments. Okay, I'm going to move on to Andrew McCormick. Andrew, why don't you introduce yourself first, and then we'll ask questions.
Great, thanks, Julie. It's a pleasure to be here. So I'm Andrew McCormick. I recently joined the BIS to run the Innovation Hub in Singapore, but I am currently talking to you from Canada as it turns out to be an impossible task moving around the world these days. I was previously the CIO and VP of payments at Payments Canada, which is the national clearing and settlement infrastructure here in Canada. If I may, I'll just say a quick word on the Innovation Hub. Obviously, the BIS has been around for 90 years, but the Innovation Hub is a new entity within the BIS, and it's led by Benoit Curé. Our current footprint is Switzerland, Singapore, and Hong Kong, but we've recently announced a bit of an expansion into the Nordics, Europe, England, and in fact Canada. And our mission is really to help shape the future of central banking through direct kind of practical research into enabling technologies that might make central banks more effective in their various roles, informing key policy areas in and around CBDCs, but also just cross-border payments, open banking, digital identity, and cyber resilience, of course.
All right. Thank you. So your organization recently published their annual report and includes a section on central bank digital currency. Many societal questions arise on the topic of digital currencies. Certainly the conversation of privacy versus utility is one of the areas of discussion. Another is, who are the stakeholders whose concerns need consideration when you think about introducing a central bank digital currency? Can you share our thoughts on the report that was released in some of these topics?
Yeah, for sure. So the annual economic report, I mean, frankly, many of the highlights have already been touched on already today in the remarks. So I think that's good that we are largely aligned on kind of the key topics. You know, in terms of, obviously, we believe central banks can and should play a role in innovation and help support digital payments, you know, going forward. Yeah, again, like, you know, the keys to point around on CBDC where, you know, there are active pilots. I think, I'm not sure it's been mentioned today, but, you know, the Riksbank and most notably the PBOC are now quite advanced on their work in this space. The decline of cash, even pre-COVID, was a noted trend and certainly one of the key drivers. Financial inclusion, disintermediation, and bank runs are key concerns in the design of these systems, and obviously public-private partnerships in terms of implementation. You know, if we think about one of the key dimensions of CBDCs, it's really revolves around privacy, right? Cash is a private payment instrument, and some would argue too private, but if the decline of cash is real, and it is, and a CBDC might, you know, replace it in one way, shape, or form, that's certainly the perspective that many central banks are looking at this issue from. Certainly the Bank of Canada in particular is positioned it that way at the very least. So, you know, the privacy dials need to be set, and that's kind of one of the key discussion points of, you know, CBDCs in our report and our work in general, where to set them. Jurisdictions vary greatly in terms of the prevailing data privacy regulations, and obviously there's a political tolerance and a societal influence on where that might ultimately lead in any given particular country. You know, I guess you know, in terms of trying to move beyond that, I think, you know, financial inclusion, you know, Harish has spoken elegantly on kind of the issues in emerging markets, but it's actually also true that even in developed markets, there's large swaths of the population that are, quite frankly, you know, unbanked or underbanked, and often segmented quite starkly in the US in particular. There's, you know, Black and Hispanic populations that are above 40-50% un and underbanked still. And so if cash is declining, what will allow those segments of the population, even in developed economies, to transact, setting aside even privacy? There's some very legitimate issues around, you know, those use cases, if you will. And then, you know, if we start to think about, you know, stakeholders, obviously there's, you know, any design, any product design, whether it be CBDC or anything else, should start with users in mind, right? Who are the users? Is it individuals? Are there corporate use cases that need to be contemplated? Is there cross-border use cases that need to be contemplated? Those are the kinds of issues that we're grappling with and thinking about from a BIS perspective and a BIS Innovation Hub perspective. And the user experience, right? You know, it's the users and the use cases and the experience that have to be really thoughtfully designed in order for something like this to be successful. The other, you know, stakeholder-wise, it's as I've mentioned, privacy regulators, parliaments, even have to change the Bank Act in many countries to issue a new type of currency. Public agencies, tax authorities, law enforcement, everyone has a stake, and obviously critically banks and payment providers also have to be thoughtfully included and not disintermediated as a result of anything in this arena. So I'll stop there.
Okay, great. Thank you. Thank you for your comments there. So David, I'm going to move to David. David, introduce yourself first, and then there's some key questions I want to ask you about that come from your book that you just wrote. But if you could
sure. Thanks, Julie, and thanks very much for inviting me along.
Yeah.
I'm an author, advisor, commentator on digital financial services. I think I was invited here by my friends at Citi for 3 reasons, really. One is I just published a book, as you very kindly mentioned, The Currency Cold War, on digital currency. Secondly, I have lived and worked in quite a few different countries advising on payments and things, so I have a reasonably global perspective on these things. But I think it's mainly because I'm old. And because I'm old, I had the great good fortune to be involved in probably 2 of the most important digital currency initiatives of the last quarter century, one of which didn't work and one of which did. And the one that didn't work was Mondex, which was based in the UK, but also in the US and Canada and Australia. And for one reason or another, which we're not going to go into, it never got traction. And the other was M-Pesa down in Kenya, which became a success beyond anybody's wildest dreams. And as Harish has mentioned, it's probably the single most important initiative in terms of bringing genuine financial inclusion that we've seen. So hopefully my experiences and some of the lessons I've learned will be useful to the next generation of digital currency entrepreneurs and regulators.
Right. So the pandemic has clearly accelerated the movement to digital across all industries. Everyone had to go to digital when we all went remote, including our public sector clients. And some say that a central bank digital currency would have been helpful to distribute everything from stimulus payments to citizens and organizations. So in your recent book, you discuss different approaches, such as domestic versus international digital currency and the importance of society in advising technologists instead of digital currency driven by technologists. Can you share your thoughts with us on that in terms of what you've seen since the pandemic? And if you were giving that advice to technologists, what advice would you give them in terms of how do we take this forward?
Sure. Thanks for those questions, Jude. I appreciate that. Well, let me answer it in 3 parts. So if we talk about the domestic stuff first, because that's easy, because I agree with everything that's been said so far. So broadly speaking, if you look at the high level business case for domestic central bank digital currency, it breaks into 2 parts. There's to what extent does it reduce costs in the economy? To what extent does it reduce the overall total social cost of payments? Cash is very expensive, and because the costs are diffuse, people don't really see them. But it is a friction in the economy. And also, I should say, by the way, in terms of inclusion and so on, I think it's also not recognized that the least well-off people pay the highest cost. Being trapped in a cash economy is not cheap. If you're trapped in a cash economy, you have to pay more for everything. You're more vulnerable. You're the person who gets mugged, or the cash gets lost or stolen, or whatever. You're the person that can't get the good online deals for things. I mean, it's not a neutral thing, people being stuck in a cash economy. It's a bad thing. But so there's the cost argument. But the other side of that is, and actually certainly in the Bank of England's work on this, the more important part is the benefit side, which is that cash, you can't do anything with it. Digital cash can have an API. It can be a platform for new goods and services and new products and amazing new things which we can't think of, but people will invent if that platform is there. So I certainly, in the Bank of England's calculations, the net benefit to the economy comes much more from the new products and services that are enabled, much less, although there is a saving, much less from the saving side. But that's the domestic calculation. So what would central bank digital currency do for a developed economy? I mean, I don't want to pick the UK. I don't feel very developed at the moment, but let's say, I don't know, Denmark, right? So everybody in Denmark has a bank account. Everybody in Denmark has a digital ID. The introduction of digital central bank digital currency to the average Dane won't make any difference, right? Because nobody uses cash anyway. They do everything with mobile phones and cards. And, you know, if you want to explain checks to them, you'd have to take them to a museum and show them around, you know, so.
Or to the United States.
Well, the United States is a very special case. And I you know, one thing I don't want to do is use either the US or China as kind of templates for, they are unique and very special cases for all sorts of, you know, we can learn a lot from the US. The US has a peculiarly inefficient financial infrastructure. I mean, the cost of the total social cost of payments in the US are far too high. And it also, you know, as an outsider, it does seem funny that they were, you know, it's 2020 and they were printing stimulus checks and mailing them out to people, dead people at that as well. And, you know, whereas I watched a fantastic video from Better Than Cash.org the other day about what was done in Colombia, where the government wanted to do stimulus, and basically they encouraged people to go out and get mobile wallets and they distributed the money largely electronically. So US and China are sort of special cases, but generally speaking, in developed economies, it wouldn't make much difference domestically until, you know, new entrepreneurs come along and build on those APIs and deliver new goods and services. I agree with everything that was said about the two-tier implementation. This was what was done in the Mondex days. You know, the way to do this is by having the central bank manage the supply of the tokens, or however we do it. I mean, I quite like the token solution, but have it managed by you know, private industries. I mean, the crucial difference between now and back then is that now you'd never dream of having that restricted to banks. Because if you're going to go down and I'll label it the Facebook route, if you're going to go down this route of issuing central bank digital cash to be an actual cash replacement, then you want it everywhere. I mean, it should be in my phone, in my car, in my laptop. I mean, it shouldn't be just in a bank account. That would get us nowhere. That wouldn't do anything. So that's the domestic thing. On the international side, of course, you have this much more interesting and much more subtle discussion which starts to wander outside my envelope, because I'm not an expert on international relations and politics. But the truth is, we're in an international money and financial system that was constructed after the Second World War to meet the, you know, which was incredibly successful at meeting the needs of the time and rebuilding global economies and facilitating global trade. But that was from a time when the US was a third of the globe. You know, times have changed. It's time to rethink that. And I don't think it would be a great surprise to anybody if some people were looking at the way the international money and financial system works and saying, well, you know, it's not a law of physics. It should respond to the circumstances. It's there in order, as you know, Mark Carney was fond of saying about the bank. It's there to serve people. I mean, it's the goal of that system is to make us all better off. And it needs to sometimes be kind of recalculated. But, you know, the fact is that has implications that go way above my pay grade, because if people around the world start using digital currencies of certain kinds, the ability of the United States to project soft power through the dollar clearing system, particularly the New York money centers, and through you know, the secondary implications of control over that system, sanctions and so on. I mean, The Economist called it financial carpet bombing, which I think is an interesting description. It's like their words, not mine. But you've got ex-secretaries of state of the Treasury now saying, you know, maybe the US is kind of overdoing it a little bit. You know, maybe what you're actually doing is nudging people into wanting to find these alternative digital currencies, and that has implications. So the international stuff is more important. And the mention of the People's Bank of China digital currency, I think, is an interesting one, because I certainly wouldn't want people to get the impression that that was some sort of knee-jerk reaction to the launch of I mean, the People's Bank of China doesn't do knee-jerk reactions to anything. You know, they're not like our banks. They have a plan. You know, they have a strategy for things. So that's a little bit different. They've been working on this for a long time, but nonetheless, they've gone down in many ways a very conventional route of going for these two-tier solutions. It's issued through third parties, etc. The crucially important point about the People's Bank of China pilots, about the DCEP, is that it reconnects with that original Mondex vision from 25 years ago, in that it allows offline person-to-person value transfers. And the importance of that cannot be overlooked. If you're going to implement a true cash replacement, so I can send money to Julie, not my bank account sending money to Julie's bank account. I mean, Julie could choose to put the money in a bank account if she wants to, but she wouldn't have to. For that, you need to be able to do offline person-to-person transfers, which you can't do using Bitcoin or anything else. So I think that's a really interesting point. And to the final point about the big picture, I do feel quite strongly about this, Julie, because I do feel we've got into a situation where we've let the technology kind of run ahead of us a bit. And I hold my hand up on that. I come from the more technological side, and I want to see what exciting new things can be done with the amazing new technologies. And in particular, some of the possibilities that are put in front of us because of cryptography and advances in cryptography are quite counterintuitive. If you don't understand that space, it's quite hard to explain to people what can be done using zero knowledge proofs and cryptographic blinding and homomorphic encryption. It's very counterintuitive if you live in a world of dollar bills and index cards, but nonetheless, it's there. But the questions that came up earlier on, how private should it be? How controlled should it be? Who should be in charge of it? Those should be political questions. Those are not technological questions. And I think it's a challenge, which I'm sure Andrew and Harish and Tommaso deal with this on a daily basis, trying to work out what society wants from digital currency. That's the very difficult part. Once Andrew and Tommaso and Harish have worked out what they want, I mean, I'm using them as a proxy for society as a whole, then you, Julie, would have no problem coming up with a working business model for that, and I would have no problem coming up with a technological implementation that would do it. So I think we've got ourselves into the situation where it's up to us to push that debate out to the wider audience. It shouldn't be people like us that are deciding how this works.
Well, and it's also what does the individual want, but also what do governments want too, because they're pull around privacy versus trying to stop money laundering, right? And getting that balance in place. And I think it's interesting what you talk about in terms of the PBC, that you have to have some way of having P2P transactions that make sense, that replace pure cash. And actually, you could probably control that better than still having physical cash, which we know is the tool that's used for money laundering in terms of how it gets placed and laundered.
Well, I just I don't have it with me, but I was just looking at an example in one of the newspapers here. There was a big set of police raids. It was a big story in England yesterday. The police broke some encryption chat application that criminals were using, and they arrested like 350 people yesterday. Yeah. And they found £57 million in cash. I can tell you what they didn't find. They didn't find Bitcoin USB sticks or prepaid debit cards. Or what they found was massive piles of good old-fashioned cash that was handed to them by the Bank of England. And I can't believe that's the right way forward, Yeah. Cash, making it cheap and easy for criminals to do business, that shouldn't be the top goal of central banks. I don't think so.
Well, I also think it's very interesting you're talking about the technology got ahead of the policy. And so you have to get to the policy and what people really want, and how are we going to achieve the right balance, societal balance, in terms of what the government wants to achieve in terms of financial stability, control, anti-fraud and anti-money laundering, and the individual's ability to have access to simple, fast, safe, cheap, payment and financial.
Well, Harish, the points that Harish raised, he hit the nail on the head with those things. We know what to do. We need agent-based networks. We did it all with M-Pesa. We need. They don't have it in the US, but we need the equivalent of the EU's electronic money institution or the Indian payment institution. The US needs. I realize the complexities of state law and whatever, but instead of that sort of fintech banking license they were talking about, they really should have gone for a national electronic money license. So we know what to do with those things. Harish is absolutely right about that. But I think getting to the point where the debate is sophisticated enough and well informed enough, that's where we might reasonably be criticized actually for not yet being able to take that debate out to the regulators and policymakers.
Well, we heard a lot today, and what I want to do is I'm going to circle back to Tommaso. I'm going to ask a question, the same question to all of you, because I don't think I heard it come out in any of your comments. Is there a market failure or a true gap in the payments landscape today that can only be solved by a central bank digital currency? I didn't hear it, but I'd love to hear from you. And then when we think about what we do want to achieve, right, in terms of cheap, fast, reliable, but accountable, not completely, we want it to be transparent. What is stopping from a policy standpoint or from an execution standpoint us aggressively improving digital identity, data sharing, cross-border retail payment infrastructure integration, the things that are going to enable us and enable the global economy? What's keeping us from doing that? So it's a two-part question. I'm going to start with Tommaso and ask you your thoughts on that, and then ask you.
Sure, thanks, Julie. And I think that no, the answer is no. There's no single market failure for which CBDC is the only solution. I think that there are a series of market failures, and I tried to point them out in my initial remarks. The concentration of the payment system in the hands of few private companies, the barriers to market contestability, barriers to financial inclusion, and these can all be solved by separate reforms. You can imagine antitrust reforms, et cetera, very targeted at market contestability, et cetera, et cetera. But it just so happens that CBDC can also help. And it just so happens that some of these reforms are difficult to implement. And so I think the argument for CBDC is not that it is the one answer to one or several frictions or problems, but that it does help along these lines. And it comes with some additional benefits. And I think some of the speakers pointed to these, particularly if CBDC is token-based and so opens up the possibility of programmable money, might open up new rails for cross-border payments that are not necessarily, that go beyond the current rails. So some of these additional benefits come with CBDC and might tip the scale in their favor. But again, it's a cost-benefit analysis that needs to be done. And it needs to be done on a country-by-country basis, because a lot of the answers will depend on how developed the infrastructure is, what alternative means of payments exist, et cetera, et cetera. Similarly, the answer to your second question, I think, is similar. Yes, we should be investing in developing digital IDs. And we know that without digital IDs, we're not going to be able to solve the problems of cross-border payment, access to cross-border payments, access to payment system. You can have the best payment system or the best cross-border rails in the world, but if there's no national ID, no digital ID, if you can't get people onto these rails, then they're not going to be useless, right? So yes, we should invest in all of these things. These are complementary reforms that need to be done. I think the example of digital IDs is a very telling one, right? In terms of it being complementary. But we also should invest in or explore solutions such as CBDC or token-based solutions in the spirit of developing a menu of options. Because why? Because we don't know which technology will win. It's too early to tell. We know that different countries have different capacities to implement different policy goals. If we tell country X, which has not very developed infrastructure, not very developed financial markets, to link up their RTGSs with an advanced economy RTGS, payment system, it's just not going to happen. And maybe in some of these cases, a token-based CBDC is the only solution, or the only possible, or the solution that is most easy to implement to solve problems of financial inclusion or to engage in cross-border payments. So again, we're really pushing for a multi-pronged solution, multi-pronged approach to developing these solutions, so that we can serve the needs of all countries, including the least developed in terms of economic development, but also infrastructure development.
Yeah, so I think what we're hearing is it's one piece of the overall tool that needs, it's one of the tools that needs to go into the toolbox to get us to where we're trying to go. In the interest of time, I'm not going to have the rest of you answer that same question right now, because we do want to leave time for questions from the audience. So at this point in time, I want to thank all of you, and I'm going to turn it over to Sophia. Sophia, you can introduce yourself, and she's going to summarize some of the key points quickly, and then we're going to turn to questions and answers.
Thank you, Julie. I hope you can hear me. I'm Sophia Bantanidis. I head up regulatory strategy and policy for Citi's Innovation Lab. So I'm involved in all the innovation initiatives at the central bank, policymaker, and regulatory level. CBDC is obviously one of the key developments I've been following since joining Citi in 2016. My colleagues in the Innovation Lab have been examining the topic since 2014, before it even became an acronym, as part of their blockchain work to see how potentially such a technology could be used to create CBDC and to inform our discussions with central banks and policymakers. So I would first of all like to thank our panel of experts and to express my gratitude for their thought-provoking comments. I have certainly learned a lot that I can take back to the Innovation Lab. I'm going to attempt to summarize and to read out my scribbled notes. We started the session with the IMF, with Tommaso, who gave us a very comprehensive overview of the state of the nation, of where we stand with CBDC. And he also took us through some very interesting examples and CBDC pilots that we have seen and what some of the learnings were. And he also stressed the importance of having to address the risks, but also the benefits. We also heard how the conversation on timing of CBDC has certainly shifted. It's no longer whether this will happen, maybe one day, it's more when it's going to happen and how it's going to happen. We also learned that the reasons that different central banks have for thinking about CBDC are quite different, and they're interested in CBDCs for different reasons. Tommaso also introduced the concept of the public-private partnership, of the way this could work. And he, as part of this, he explained the concept of synthetic CBDCs. Then we heard from Harish from the World Bank. Harish addressed the topic of financial inclusion and whether or not the introduction of a CBDC could address and could help us get to a more inclusive financial services system. And he said, well, it doesn't necessarily offer a superior solution. One really needs to weigh out and evaluate the other options that are out there. And one also needs to look at the risks. And mitigating these risks would be more difficult in certain emerging markets. He also gave the example of certain countries like Kenya and Tanzania that have made quite a bit of progress in financial inclusion. Then we went on to Andrew from the Bank of International Settlements and the Innovation Hub, who talked us through the key findings from their annual economic report and talked about some active pilots that certain central banks have, like Sweden, for example, and certain dimensions that policymakers and regulators need to address, like the privacy angle, for example, and the privacy dials that need to be set. And he also explained that there are various stakeholders that would need to be involved and need to be consulted, including tax authorities, including privacy regulators, including banks as well. Everybody has a stake. Then we went to David Birch. David, you shared some very interesting insights from your latest book, and you touched on some of the broader societal questions as well. A couple of interesting things that I've highlighted and I've taken away from your remarks is, if we were to implement CBDC as a true cash replacement, it would need to be available offline and person-to-person transactions. You also talked about the very important political questions that need to be decided on trying to work out what society wants out of this, and it's society that needs to come up with this. And you also explained that actually what has happened, rather absurdly, is the technologists have gotten ahead of the game and are leapfrogging ahead. So that's sort of in summary what we discussed. We now have some Q&A. We received some questions from our audience. There are 3 questions. The first one is, what are the key catalysts that will help promote the use of digital currencies by central banks? So we talked about some catalysts, but what are the real key ones? Who would like to answer that?
I can have a shot at that, because I think I'm going to need to defer to my colleagues here in emerging markets, because I think it differs. So in developed markets, it's more about this innovation platform. It's more about moving over to central bank digital currency as a way of encouraging new products, new services, ways to do business in new ways. If you take out clearing and settlement from an awful lot of financial transactions, you can make things a lot more efficient. And I tend to think that, I mean, I agree with the point that was made about, token-based implementations, because I rather imagine that the tokenization of digital assets is a much bigger trend in its own right than just digital currency. So what I would imagine will happen in the developed markets is you'll have these digital asset tokenization platforms growing up, and one of the uses of those will be central bank digital currency, and then people will build on top of that. In emerging markets, it's a very different dynamic, because it's driven by, I'll come back to the US in 1 second, it's driven by inclusion, cost reduction, anti-corruption, many other things which aren't quite the same. In the US, you have 100 million people who are either unbanked or underbanked. You have a cost of overall financial intermediation, which hasn't changed, as far as I'm aware, for about a century. So despite all of the technological innovations, finance still takes up the same chunk of the economy, and bringing more efficiency into that space would be a real benefit to the rest of the economy. So it's a as you'd expect me to say, it's a different driver depending on the different environments.
Maybe to add to what David was saying, from the emerging markets, I think one of the biggest catalysts could be if the public moves towards adopting other forms of digital currencies, and the countries then feel that they will lose control over their monetary policy and monetary base. I think that could be a very big trigger. And then also, if one of the reserve central banks with reserve currencies is in, then the risk of dollarization or the equivalent of that is also significantly higher, and that could also perhaps impel movement in emerging markets. And of course, there's a related trend, I think, which is perhaps applicable all over the world. I think if there's a decline in use of cash, then I think to protect certain segments of the society, I think there's a need then to look at a kind of an alternative to cash, and that could also be a trigger. But then in emerging markets, I think that seems to be a little further down the road at this point.
Yeah, I think that issue of cashlessness is important, Harish, because I think what we've seen in developed markets, I mean, Sweden is the example that everybody uses, is where we've just allowed cashlessness to happen. It's not been the optimal outcome. But by just allowing cashless, driven by natural, private sector drivers, we end up with people who are marginalized and excluded, and that's not what we want. So it's not particularly just to do with central bank digital currency, but you're right that we need a strategy towards cashlessness as well as a strategy towards central bank digital currency. The two are related, obviously, but they're not the same thing.
Thank you, Harish. Thank you, David. Our next question, it's about timing, really. So why has it taken it so long for CBDCs to take off, despite the increased need to handle money laundering and financial exclusion of the poor? I mean, I don't know, maybe Andrew, you have some thoughts to share around it in terms of surveys you do. I've been reading them every year, and the percentage of central banks that are exploring this, experimenting, looking at it, goes up every year. I think the latest percentage is 80%. Maybe. Right.
Yeah, I mean, look, I represent part of this ecosystem that is famous for not moving super quickly on anything, and usually there's a pretty good reason for that, which is around the stability, integrity of these systems, which are so fundamental and foundational to any economy, right? So these movements into new methods of payment, especially ones with tectonic shifts associated with them, have to be measured and really well thought out. And so that's the reason. But it's also true that we don't move too quick on any kind of, upgrade, whether it be an RTGS system or an introduction of a fast payment system, or so on and so forth. So guilty as charged, but I think, everyone would agree that the prudence and the stability aspects have to be well thought out, so that it's not a half-baked solution that gets put into market, right? That's the simplest answer I can drum up.
I just, Sophia, just to say one little thing about this, but it's an odd question. I didn't realize you were going to ask that question, but I just posted a little video on my YouTube channel today about this, because I'm down with the kids, right? I've got a YouTube channel. I'm on Instagram too, by the way. I'm just saying. But, it's not a completely trite answer to say the reason why we're getting digital currency now is historians talk about steam engine time. They say, why did we get steam engines in England at that part of the 18th century? And you can point to all sorts of things, the fuel and the advances in technology and the availability of capital. You can point to all of these things, but the truth is it was no one thing. We got steam engines because it was steam engine time. And this is digital currency time. There's no one reason. It's all of those things coming together that make it digital currency time.
I might add, though, that is also, now is the time for a financial layer of the digital economy, right? And how we do it, whether it's a CBDC or whether it's upgrades in the identity infrastructure, in the payment infrastructure, in the open banking and data sharing infrastructure. All of those pieces have to come into place, and the CBDC only solves one of them. It doesn't inherently solve identity. It doesn't inherently solve open banking constructs. So it's an ingredient, but it's necessary, or maybe not even necessary, but it's certainly not sufficient to get us to what we want as a digital global platform for value exchange, right?
Completely agree, Andrew. Completely agree. It's only one part.
One part.
Mm-hmm. Thank you for that, Andrew and David. We have another question. It picks up on a point that David actually mentioned in his remarks. It's about China. So can you address China's early leadership in CBDC? Also, what might this mean for emerging markets with a close relationship with China, such as Ethiopia? Any views?
I'm happy to take that if everybody else is too sensitive to talk about it. Look, as I said, this isn't some kind of knee-jerk thing that China just thought up because of Libra, okay? So there's a long-term strategy here. In a lot of banks that you're used to working with, Sophia, not Citi, obviously, but in a lot of banks, the long-term planning department is looking at what's going to happen at Christmas, right? The People's Bank of China has a long-term plan to improve the efficiency of the Chinese economy and to extend Chinese soft power. It's a perfectly reasonable goal out along the Belt and Road and into other countries, and reduce dependence on the dollar for international transactions. So they're doing this as part of an overall strategy. The technologies they're choosing for it are technologies that are available to all of us. It's not like they've come up, someone has invented a magic box that can do this and we're all stuck without it. That's not what's happened. It's the strategy that's the important part of that. Now, in terms of what that might mean in Ethiopia, which I think is part of the Belt and Road Initiative, isn't it? That's interesting. You talked about, I think it was Harish talked about the substitution of local currencies. The word I prefer, the word I used in my book was permeation. So it isn't that people are going to stop using the local currency and start using digital dollars or digital yuan, but those currencies will permeate the local economies. And that will cause all sorts of problems for the management of those economies. Now, I'm not a politician. It's not my job to try and resolve those things. But what I might observe is there is some good research evidence that the availability of strong, stable currencies in some of those environments is actually to the net welfare. So it might not be that the interests of people that run countries and control central banks are the same as the interests of the people in those countries. Now, I'm allowed to say that, and other people around the table aren't allowed to say that. But the truth is, it might not be the worst possible outcome for some countries if people find themselves using one of the permeating currencies rather than the local currency. You can turn it off now, it's okay.
I might add one point, and in terms of the leadership and the active role they've taken, it's also true that the central bank in China was overtaken, or payments in general in China were largely overtaken by, two big tech companies over the past 15 years. And so this move also represents domestically an opportunity to get central banks and commercial banks back in the game.
Fair point. Yeah, fair point.
Thank you. I'm conscious we're out of time now. Just Tommaso, just to give you the opportunity, did you want to add anything to that, or shall we end here?
I'm happy to add very briefly, maybe an answer that rejoins your first question as well, which was about timing and catalysts. Some people think that there's a first mover advantage to central banks introducing CBDC, and that that might induce other central banks to follow suit. And the argument is that if you're a first mover, your currency then gets adopted more widely. But I think it's important to remember that there are reasons for currencies to be used widely. There are reasons for currencies to be considered reserve currencies, and those have a lot to do with institutional stability, market depth, and these are not things that are going to change from one day to the next with the mere introduction of a digital form of money. So I think that the shifts in which currencies are reserve currencies around the world will continue, but will continue to be relatively slow despite the potential introduction of digital currency. Thank you.
All right. Well, thank you all. Thank you all for joining us today. I think it's been a great discussion. And I think, I think what I took away from the discussion today is that, central bank backed digital currency is one element of many things that is going to get us to where we need to go with our payment systems and with the digital, and that it's not the one solution, but it is an important element. It is an important that can actually help drive some of the other activities and developments around it that would make this all work a lot better. So I really thank you all for your insights and participating over Zoom to make this happen. And for any questions that we didn't get to answer today, if anyone who's on this call listening and has questions, we'll figure out ways to direct them and connect you with speakers or try to get back to you in some way. So we thank everyone for joining, and most of all, thank the panelists for joining us from literally all over the world to have this great conversation. All right.
Thanks for the invitation. Really appreciate it.
Thank you very much.
All right. Take care.
Thank you.
Thank you.
Bye, guys.
Bye.
Bye.